Hey investors! Today I'm going to walk through the exact 10-step process I use to analyze stocks before deciding whether to invest or not. As a value investor, my goal is to find great companies trading at undervalued prices with strong potential for future growth. This analytical approach helps me cut through market noise and hype to make rational, evidence-based decisions. Whether you're a seasoned investor or just starting out, I believe having a consistent, thorough process for evaluating stocks is crucial. So let's dive into my 10 steps. Step 1. Broad economic and market analysis. I always start by looking at the big picture, analyzing the current state of the overall economy and market environment. What's the GDP growth rate? Inflation levels? Interest rates? Consumer confidence? I want to understand the macroeconomic tailwinds or headwinds that could impact company performance across sectors. I also look at market indices to get a sense of overall valuation levels and investor sentiment. This broad analysis helps me identify potential areas of opportunity or risk. Step 2. Sector and industry analysis. Next, I zoom in on the specific sector and industry the company operates in. What are the key drivers and trends affecting that industry? Regulatory changes? New technologies disrupting incumbents? I analyze the competitive landscape. Who are the major players? What are their strengths and weaknesses? I also look at growth forecasts, profit margins, and other metrics for the industry overall. Understanding a company's sector and the forces shaping it is critical context. Even a great business can struggle if its entire industry is under pressure. So this sector-industry due diligence is an essential filter before moving on to analyzing the individual company itself. Step 3. Analyze the company's products, services. With that sector-industry context, I then start digging into the specifics of the company, beginning with its products and services. What exactly does the company sell? And how do its offerings compare to competitors in terms of quality, pricing, and differentiation? I want to make sure I have a solid understanding of the company's revenue streams and market positioning. I also look for durable competitive advantages, be it proprietary technology, switching costs, a powerful brand name, or an entrenched ecosystem. Sustainable competitive edges are key for a company to maintain pricing power and fend off rivals. Step 4. Evaluate the management team. Next up, I research the company's leadership, starting with the CEO, but also the executive team and board of directors. What are their backgrounds and track records? I'm looking for leaders with relevant expertise, a talent for strategic decision-making and capital allocation, high integrity, and a demonstrated alignment with shareholder interests. I read interviews and watch videos to get a sense of their vision and communication skills. Exceptional management that can nimbly navigate challenges and execute on long-term plans is invaluable. That's why getting a handle on the quality of the people running the company is so important in my analysis. Step 5. Analyze financial statements. This is where I really roll up my sleeves and dig into the company's financial statements and key metrics. I analyze trends in revenue growth, profit margins, cash flows, debt levels, capital expenditures, and returns on equity assets over the past 5-10 years. I'm looking for consistent, profitable growth with prudent financial management. Particular areas of focus are the quality of earnings and revenue recognition policies, separating out one-time versus recurring items, and evaluating the footnotes for any irregularities. I also use financial ratios like P/E, P/S, P/FCF to gauge valuation compared to historical levels and peers. Reading quarterly, annual filings, earnings call transcripts, and talking to a company's investor relations team are part of this diligence process too. My goal is spotting both sustainable competitive strengths and potential red flags early. Step 6. Forecast future financials. After thoroughly analyzing the historical financials, I build out a multi-year forecast model to estimate the company's future earnings, cash flows, and other key metrics. This allows me to pressure test various scenarios and assumptions around growth rates, margins, capital needs, etc. Based on this forward-looking model, I can then better assess whether the company's current stock price offers an attractive expected return. Forecasting is far from an exact science, but it's a critical exercise to gauge the range of potential outcomes and valuations looking ahead. Step 7. Assess competitive advantages and risks. Next, I take a step back and systematically evaluate the company's sustainable competitive advantages and potential risks. What are the structural barriers to entry, product differentiation, cost advantages, or customer switching costs protecting its profitability? And what disruptive forces, new competitors, or other risks could derail the company's growth trajectory? Weighing these strengths and weaknesses in an objective, clear-eyed way is essential. Step 8. Value the business. Now it's time to put an actual valuation on the company's stock price based on all of my analysis thus far. I primarily use discounted cash flow (DCF) analysis to estimate the company's intrinsic value by projecting future free cash flows and discounting them back to today's present value at an appropriate rate. I compare this DCF-derived fair value to the current stock price to see if shares are undervalued, overvalued, or fairly priced. As a value investor, I'm looking for at least a 30–40% margin of safety between my conservative valuation estimate and the current market price before considering investment. Step 9. Invest with appropriate position sizing. Even after all of that rigorous analysis, I know I can never predict the future with certainty. So if I ultimately decide to invest, I follow disciplined position sizing and portfolio management rules. For individual stock positions, I typically don't allocate more than 5% of my overall portfolio to any single company. This helps limit my downside if my investment thesis proves incorrect while still allowing plenty of upside if I'm right. Conclusion. There you have it. Those are the key 10 steps I follow to thoroughly analyze stocks as part of my investment process. It's certainly intensive and time-consuming, but I believe putting in this diligence work up front pays dividends in the long run. Finding great companies with solid fundamentals trading at attractive valuations is how I aim to generate market-beating returns. I hope walking through my approach was helpful for you all. Let me know if you have any other questions.